For decades, Rolex dealerships operated with one powerful belief: demand would always exceed supply. Waiting lists stretched for years. Customers paid massive premiums on the secondary market, and authorized dealers held unprecedented control over the luxury watch business. But now, something unexpected is happening. The market that once seemed untouchable is beginning to crack. Prices for many of the most hyped Rolex models are falling. Showroom traffic is slowing, and some dealers are facing a reality they never imagined possible. What was once considered a guaranteed investment is suddenly looking far less certain. Economic uncertainty, rising interest rates, and changing consumer behavior are reshaping the luxury watch industry at incredible speed. Social media hype helped push Rolex prices to historic highs, but that same online culture is now fueling panic as values decline. For dealer, number 8. The impossible problem nobody expected. For years, the world believed technology could solve almost anything. Faster computers, smarter algorithms, and endless streams of data created the illusion that every problem had an answer waiting to be discovered. Governments trusted artificial intelligence to predict economic trends. Corporations depended on automation to maximize profits, and ordinary people relied on digital systems for nearly every aspect of daily life. But then came the impossible problem nobody expected: a crisis so complicated that no machine, expert, or institution seemed capable of fixing it. It wasn't a war, a virus, or even a financial crash in the traditional sense. Instead, it was the terrifying realization that modern society had become too interconnected to control. One failure triggered another like falling dominoes. Supply chains broke down because factories lacked workers. Workers disappeared because housing became unaffordable. Housing became impossible because interest rates surged. Interest rates rose because governments printed too much money during emergencies they barely understood. Every solution created two new problems, and the cycle kept accelerating. Economists argued on television while markets collapsed in real time. Billion-dollar corporations suddenly looked fragile. Luxury brands that once symbolized untouchable wealth began cutting prices to attract nervous buyers. Consumers stopped spending. Investors stopped believing. And confidence, the invisible force holding the economy together, started to vanish. The most shocking part was that nobody saw it coming. Experts had predicted recessions before, but this felt different. It was as if the entire system had reached a level of complexity beyond human understanding. Number 7. How Rolex became bigger than luxury. What began as a small watch company in the early 1900s eventually transformed into something far greater than a luxury brand. Rolex became a global symbol of success, power, and financial status in a way almost no other company ever achieved. Luxury brands usually sell products people admire, but Rolex created something different: its old recognition. The moment someone sees the crown logo on a wrist, they instantly associate it with wealth, achievement, and exclusivity. Over decades, Rolex carefully built this image through precision marketing, limited production, and an obsession with reputation. Unlike fashion brands that constantly chase trends, Rolex focused on timelessness. A Rolex watch from 20 years ago can still look modern today, which helped create the idea that owning one was not simply a purchase but a lifelong milestone. The company reinforced this image by associating itself with elite sports, explorers, celebrities, and world leaders. From deep-sea expeditions to Formula One races and Hollywood events, Rolex positioned itself wherever prestige existed. Eventually, the watches became more than accessories, they became cultural trophies. What truly pushed Rolex beyond traditional luxury, however, was the rise of scarcity and the secondary market. Demand exploded worldwide while production remained tightly controlled. Popular models became nearly impossible to buy at retail stores, creating waiting lists that stretched for years. Instead of losing customers, this scarcity made the brand even more desirable. People began viewing Rolex watches like rare assets rather than ordinary consumer goods. Some buyers purchased watches not to wear them, but to store them like investments. Number 6. The gray market is cracking. For years, the gray market surrounding Rolex seemed unstoppable. Dealers, resellers, and private flippers built entire businesses around the idea that luxury watches would only become more valuable over time. Popular Rolex models were merely impossible to buy directly from authorized dealers, creating massive waiting lists and intense frustration among customers. That shortage opened the door for the gray market to explode. Buyers who didn't want to wait years were willing to pay enormous premiums just to get a watch immediately. At the peak of the frenzy, some Rolex models sold for double or even triple their retail price. Social media fueled the hype even further, turning watches into financial assets and status symbols at the same time. Influencers constantly showed off collections worth hundreds of thousands of dollars, while YouTubers and TikTok creators convinced millions that luxury watches were better than cash. It created the illusion that prices could rise forever. But now, the gray market is beginning to crack. Demand is slowing, prices are falling, and confidence is fading across the luxury watch world. Dealers who once acted untouchable are suddenly struggling to move inventory. Some resellers who borrowed money to buy expensive watches at inflated prices are finding themselves trapped with assets losing value every month. Watches that once sold instantly are now sitting unsold for weeks or even months. The psychology of the market has changed completely. During the boom, buyers rushed to purchase watches out of fear of missing out. Today, many are waiting because they believe prices could fall even further. That shift in mindset is dangerous for any speculative market because luxury value depends heavily on perception and confidence. One major reason for the decline is the weakening global economy. Number 5. Dealers are facing a new reality. For years, luxury watch dealers operated in what felt like a perfect market. Demand for brands like Rolex, Patek Philippe, and Audemars Piguet was so intense that almost every desirable model could be sold instantly at massive premiums. Dealers barely needed to convince customers to buy because fear of missing out did the work for them. Buyers were willing to pay thousands above retail prices simply to avoid waiting lists, and many believed luxury watches were safer investments than stocks or cryptocurrencies. During the peak of the boom, dealers expanded aggressively, rented expensive showrooms, hired more staff, and stocked huge inventories expecting endless growth. The entire industry became addicted to rising prices and constant hype. But now, dealers are facing a completely different reality. The market that once rewarded almost every purchase is becoming slower, riskier, and far more unpredictable. Watches that previously sold within hours are now sitting in safes for months. Customers are negotiating harder, delaying purchases, or disappearing altogether. Dealers who bought inventory at peak prices are watching values decline while their operating costs remain high. In some cases, the profit margins that once seemed effortless have nearly vanished. A watch purchased 6 months ago at an inflated market price may now be worth significantly less, turning what once looked like an easy investment into a financial burden. One of the biggest shocks for dealers is the sudden change in customer psychology. During the boom years, people believed prices would continue climbing forever, so buyers rushed into the market with urgency. Today, that urgency has turned into caution. Consumers are no longer afraid of missing out, they are afraid of overpaying. Many buyers Number 4. Social media created the monster. Social media did not just promote the luxury watch boom, it helped create an entirely new culture around it. Platforms like Instagram, TikTok, and YouTube transformed watches from personal accessories into global status symbols viewed by millions every single day. Brands such as Rolex, Audemars Piguet, and Patek Philippe became more visible online than ever before, constantly appearing in celebrity posts, influencer videos, luxury lifestyle clips, and viral success content. Suddenly, owning a luxury watch was no longer just about craftsmanship or tradition, it became part of an online identity. A Rolex on someone's wrist signaled wealth, ambition, and exclusivity in a single image. Social media turned these watches into visual proof that someone had made it. The algorithms made the situation even more extreme. The more people engaged with luxury content, the more platforms pushed it into millions of feeds worldwide. Young audiences who previously knew little about watches were suddenly surrounded by videos claiming certain models were better investments than stocks. Influencers showed collections worth hundreds of thousands of dollars while talking about easy profits and skyrocketing resale prices. Watch flipping channels exploded in popularity, making the luxury watch market look like a fast track to number 3. The economy is changing luxury spending. The global economy is beginning to reshape the way people think about luxury spending, and the change is becoming impossible to ignore. For years, consumers around the world spent aggressively on high-end products, fueled by low interest rates, rising asset prices, easy access to credit, and the belief that wealth would continue growing indefinitely. Luxury brands like Rolex, Louis Vuitton, Hermes, and Ferrari benefited enormously from this environment. Expensive watches, designer handbags, exotic cars, and luxury travel became symbols of success displayed constantly across social media. Spending on luxury no longer felt reserved only for the ultra-wealthy. Millions of people stretched their finances to participate in the lifestyle because the culture around status and image became so powerful. But economic conditions are changing rapidly. Inflation has increased the cost of everyday life. Interest rates are much higher than they were a few years ago, and financial uncertainty is making consumers far more cautious. Housing costs, energy bills, food prices, and debt payments are consuming a larger share of household income, even for many upper-middle-class earners who once spent freely on luxury products. As financial pressure grows, people are starting to separate true wealth from performative spending. The era of buying expensive items simply to signal status online is becoming harder to maintain when economic anxiety dominates daily life. Luxury markets are especially sensitive to shifts in confidence because they depend heavily on emotion. Consumers buy luxury products not only for quality, but also for the feeling of success, stability, and aspiration they represent. When the economy feels strong, people are more willing to indulge. Number 2. Could Rolex prices fall much further? Could prices for Rolex fall even further? The short answer is yes, but probably not equally across every model. The luxury watch market is going through a major correction after years of extreme speculation, and many analysts, dealers, and collectors believe the industry still has not fully stabilized. During the peak of the boom between 2020 and 2022, some Rolex watches traded at absurd premiums far above retail prices because buyers believed demand would remain endless. But markets driven by hype rarely stay overheated forever. As global economic conditions tighten and speculative buying fades, prices across many models are continuing to soften. Recent market data already show significant declines from peak pricing. Some newer Rolex releases have reportedly dropped more than 20% from their initial secondary market highs, while several previously untouchable models are now much closer to retail pricing than they were a few years ago. Dealers are also seeing slower sales, longer holding periods, and reduced profit margins as buyer confidence weakens. What once felt like guaranteed appreciation is now starting to look like a normal cyclical luxury market again. However, the important detail is that Rolex is not one single market. Different models behave very differently. Highly desirable steel sports watches such as the Daytona, Gemmed Mastery, and certain Submariner references still maintain strong demand and trade above retail because production remains limited and collector interest is deeply established. Meanwhile, less hyped models like certain Datejusts, Explorers, Yacht Masters, and precious metal references have already experienced sharper corrections and, in some cases, now trade below retail prices on the secondary. Number 1. The real lesson behind the Rolex slowdown. The slowdown in the luxury watch market, especially around Rolex, is not just about falling prices or a cooling gray market. The real lesson is about how modern value systems can become disconnected from reality when emotion, speculation, and social media hype take control of a market for too long. For several years, luxury watches were no longer treated purely as craftsmanship or collectibles. They became financial instruments in the eyes of many buyers. People began purchasing Rolex watches not because they wanted to wear them, but because they believed they would automatically rise in value. This mindset transformed the traditional luxury industry into something closer to a speculative marketplace. When demand is driven more by expectation of profit than by genuine appreciation, prices can climb far beyond what real, long-term demand can support. The slowdown shows what happens when that expectation breaks. As global economic conditions tightened, interest rates rose, and consumer confidence weakened, buyers started questioning whether luxury watches were truly investments or simply expensive goods with volatile resale value. Once that doubt entered the market, behavior changed quickly. Instead of rushing to buy, consumers began waiting. Instead of chasing scarcity, they started looking for stability. That shift alone was enough to expose how much of the previous boom was built on psychological momentum rather than sustainable demand. Another key lesson is the role of perception. Luxury has always depended on exclusivity, but in recent years, visibility became just as important as exclusivity. Social media turned watches into symbols of identity performance. Owning a Rolex was not just about personal enjoyment, it was about being seen owning it. Platforms amplify